Over and over again, I see ICT students and other trading students make the same mistakes. You all overcomplicate every single thing. So in this video today, I'm going to simplify your trading by teaching you how one 90-minute window can actually retire you. The first thing you have to understand about trading Nasdaq in particular is that there is one 90-minute time window where all your trades should come from. Now, in this video today, we will cover higher time frame analysis, and I'll give you a simple way to make it easy, connected ranges and how we use each side of a connected range, the time window I'm talking about, which is 9:30 a.m. New York Eastern Standard Time till 11 a.m. New York Eastern Standard Time, and then entry framework, which involves anything SMT, IFEG, 2022 entry model, change in the state of delivery, all of those things. These first three are the main important things. So first of all, higher time frame analysis. This becomes really easy when you can predict the monthly candles direction. If you can predict the monthly candles direction, everything else below it is easy and a trickle down effect, meaning you'll be able to predict a weekly candle, a daily candle, etc. If you cannot predict the monthly candles direction, drop to the weekly and see if you can predict that. If you cannot predict the weekly candle's direction, drop to the daily and see if you can predict the very next daily candle. If you cannot then predict the very next daily candle, literally do nothing. Doing nothing is actually more in trading. It's the only business, and this is why people struggle with it so much, where doing less is actually more. So this is the monthly time frame on Nasdaq, and we're asking one simple question. What is the very next candle likely to do? Is it likely to go higher or lower? And can I predict this? Well, you have accumulation inside of here. If we look at this candle's high and this candle's low, we have multiple candles just consolidating without taking out the high or the low here. Now, what you guys need to understand is each side of this candle holds liquidity. And when we trade into one side of it, we're looking for a rejection, because we have swept equal lows when they form here, meaning sellers are tricked into the market below this low. Their stop losses rest above previous candle high, and equal highs up here, meaning they don't want to see resistance be taken and traded above. So when they're tricked into sell positions in down close candles, we can potentially target the other side. When we ask the question, what is the very next higher time frame candle doing? What has the previous one done? Well, it's traded into sell side liquidity, so you have a key level, and it's rejected from it. It closed back inside the range from this low to this high. It gave some form of rejection. So we can predict the next monthly candle to be bullish, and then at least until these equal highs. So we drop down to the daily time frame, and you can see here, when we take out those sell stops, I've put these eyes here because what you guys want to do to gain an understanding of higher time frame analysis and analysis in general, because the time window, the 90-minute window, we will be focusing on, this is a very common theme that you want to train your eye towards. Equal highs get left behind. Equal highs get left behind. Now, when you have equal highs and you've established a bias through predicting the next candle, whether that's a monthly, weekly, daily candle, when you have equal highs, they are obvious targets. So we take out one side of this range high and range low. The sell side liquidity gets taken. Now we are waiting for displacement. And if we look at this inside of here, we have a bearish fair value gap here. Now, if you were bearish, you would like to see this hold. We've displaced through sell stops. So ideally, you'd like to see this hold, but we're switching gears because we're already predicting the next monthly candle to be bullish. So when it gets displaced through and closed above, it can be used on the other side to accumulate new buy positions. The same thing happens here. And I believe this is where the new monthly candle, the bullish one we were predicting beforehand, actually starts. So what does it do? It opens up, trades below previous day low to gather sell stops on an open low high close play. We then also close above this inverse fair value gap. At this point here, closing above two PD arrays, two premium arrays you'd like to see hold price lower in a normal scenario, you can say that the change in the state of delivery has occurred, meaning we're switching gears from sell side, from the algorithm constantly driving to take sell side liquidity to now switch gears to constantly drive and aggressively target buy side liquidity. Buy side liquidity being a key one, equal highs. Look at the momentum here towards those equal highs. We then leave behind a fair value gap, trade into it, and distribute higher. The point I am making here, first of all, your eyes should jump to these equal highs because you've been able to predict a higher time frame candle. After that point, everything else becomes very, very easy. So again here, another example of the monthly time frame. What we have done is left a high back here. Buy stops get taken out, external range liquidity gets taken out. We then get a candle rejection above here. This candle trades higher, but closes back inside the previous candle. That alone is kind of irrelevant, to be completely honest. But when you partner it with the fact that we've just taken out buy side liquidity, we can now predict the next candle at least trade into previous month low, and it does so here. We then go into this candle and trade above the previous candle high once again. You have SMT at all-time highs there with ES. This is Nasdaq monthly time frame. We then reject it and close below. At this point here, you have to understand what we've done. We've traded above buy side liquidity, so buyers are in the marketplace. What do you think they're doing on these long wicks here? Buying, of course. We take out a previous candle high and reject massively. We then close back inside the body of this and we close in the lower portion of it. So this candle is predictably bearish. Where does your eye jump to? Equal lows. It should always jump to equal lows and equal highs. And then this is also bearish. Where does your eye jump to again? Equal lows here, failure swing. And then relative equal lows, 1, 2, 3. And again, here is the daily time frame. You've gone from monthly to daily. On the daily time frame, we run above that monthly external range high, and then we get that monthly previous month high stop run. We then displace away. As soon as we close below the up close candle here that started the move into the previous month high, the change in the state of delivery has shifted again. At that point there, as soon as that daily candle closes, your eye should instantly go in towards equal lows. You see many here, you see many here, you see many here, and all the way down here. Train your eyes to jump to equal lows and equal highs, because not only is it important on these higher time frames, it is also very important when you're scalping in the 9:30 to 11 a.m. window. And then from that point forward, when the delivery shifts from bullish to aggressively attacking buy side liquidity to aggressively attacking equal lows and sell side liquidity, every fair value gap starts to hold price lower. Every up close candle starts to hold price lower. Once again, we retrace, go lower, fair value gap paired with the order block goes lower. And these are both predictable monthly candles. You can engage with the daily candles inside of here. So that is how you simplify the monthly time frame. Now we're going to go on to our second topic, which is ranges. As soon as you can predict a candle's direction, you are only looking for two things: range lows or range highs being engaged and trading back to 50% of the new range or the opposing end of the range. You are also looking for price to trade to imbalances. So what does this look like visually? Well, you can see here we're on the Nasdaq daily chart of the same example. You have a range low and a range high. Do not overcomplicate ranges. The most obvious connected price swing on your screen. Where does this move originate from, this bullish move? And where does it stop and trade back into the range? That is your extreme range high, that is your extreme range low. High probability trades come at the range extremes, and then you compare smaller ranges. So we have the range extremes taken, you have the monthly time frame on your side, you're already predicting price to be bullish, which we covered with the higher time frame analysis, and then you can use lower time frame ranges. If we drop to the 4-hour chart now, every single stop run, again I mentioned, you should only be looking for price to rebalance imbalances and take out range lows to target range highs. You have an imbalance here. Price rebalances the imbalance, also takes out a range low, and then trades to the range high, and also 50% of that new dealing range. When one side of it gets taken out, opposing to your higher time frame bias, you can measure this high to this low. 50% where we have equal highs is a place you want to target. Imbalance trades into, moves away to the range high. Range low, consolidation, accumulation, manipulation, distribution to the range high once again. Accumulation, new range low forms, trades into it, overlapping with a fair value gap, connected range high gets targeted on the buy side. And then an even smaller fractal of that is you have the range high and range low, connected price swing, nothing inside of here for you to do until we take out one side of that dealing range. Your eye should instantly go to the premium of the range high to the new range low where we just swept the range low out. Your eye should shoot to equal highs inside of that 50%. Range low, range high, overlapping with an imbalance. We trade down into the range low. Your eye should instantly go to these equal highs, which you can target on the longs. Again, close above the down close candles here. That's your entry, stop loss below the bodies, target these equal highs or the opposing end of the range if it's in line with your daily bias. Ranges will solve the market for you. And then you have the golden 90-minute window, 9:30 a.m. New York EST till 11 a.m. EST. All you need to be profitable and quit your 9 to 5 is trades within this time window, having established the above that we've already gone through. Daily bias, some form of higher time frame bias, range low or range high engaged, then this execution window and your entry framework. So what does this look like? Again, here is the monthly time frame. You trade above into 31,000, sorry, this is the daily time frame. You trade into 31,000 big figure level. We trade above previous day high and close back inside the previous candle. So we've hit a higher time frame key level. When you're at higher time frame key levels like all-time highs, you want to use big figure levels. We trade above previous day high, close back inside. So this candle is predictable. Where does your eye instantly go to? Equal lows. This candle is also predictable. Where does your eye go to? Imbalances, volume imbalance there, and relative equal lows here. So these are the predictable daily candles. Then on the hourly time frame, previous day high engaged, we drop down and we form a range. When we form a range, again, your eyes are instantly going to the range high and range low, but also we have equal lows down here, which are an obvious draw on liquidity. We then come up, take the range high out, and then look what happens. Does price wait around? No, it instantly reverses to the range low and relative equal lows, imbalances inside of 50% of that new dealing range. That is all you need to take a trade. On the lower time frames, what does this look like? This is the golden window, the 90-minute window you're looking for. What you need to see during this 90-minute window, you've established bias. You need to see a range high taken out. Now, first of all, again, equal lows. Do we have obvious liquidity to target? Do we have equal lows or equal highs to target? Yes, we've accumulated all throughout here. We then have 9:30 a.m. open up around here. You are waiting for a range high to be engaged. You already want to be bearish because we've established higher time frame framework. So when we go into 9:30, you want to see a range high engaged and then displacement away. When we engage this range high here, do we get displacement there? No, there's nothing for you to do there. Do we then get displacement after running out 1, 2, 3 drives higher? We're in the heart of our 9:30 to 11 a.m. window, and then we displace through the up close candle that traded into this high. At this point here, what do we say? The delivery has shifted. Now your fair value gaps will hold price lower. If you do not get that entry there, you can look up close candle. We've already shifted the delivery. Up close candle that is lining up with an inverse fair value gap, and then that can be an entry with your stop loss above the swing high. From this point forward, all of the up close candles and fair value gaps start holding price lower until we engage the relative equal lows. Every execution inside of this time window is extremely easy, and it is all you need to become profitable. So the next example, you have Nasdaq daily time frame. You have a dealing range, displacement that took out buy side liquidity and sell side liquidity. We are looking for price to do something now. It takes out one side of this candle's range. We take out sell side liquidity, and then we get an SMT with ES. This candle is an inside candle, so we don't focus on it. But then this candle, ES trades below here, and then this one displaces away. So you now have a predictable next candle, which is the only thing you're trying to do. Predictable to where? Previous day high, and then this external range liquidity, because again, where does your eye go? To relative equal highs inside of a premium. To the hourly time frame, there's the SMT with ES. Your eyes should instantly shoot to relative equal highs inside of that premium and the range high of that range. So this is the predictable daily candle. We start off, we consolidate, we accumulate, and then a range low and a connected range high forms. This is the most obvious connected price swing on your screen. We then sweep one side of it and trade to the other side during our key time. So New York session opens up, we look for one side of this range to be taken out, which it does, and then we can go to the lower time frame for execution. Again, range low engaged. We've already established we want to be looking for longs. We take out the range low, trade down into it and displace away. Trade down into a fair value gap, and where does your eyes go? Instantly. Again, relative equal highs are your everything. This is also the connected range high. During this 9:30 till 11 a.m. window, 9:30 trades into the range low, so you have 9:30 manipulation. We then get distribution higher. So I hope you found this video useful. This is the first episode of a Nasdaq Masterclass series I'm doing on YouTube. If you guys want episode 2, then please let me know in the comments. Drop a like if you enjoyed the video. Subscribe if you are new. I'm trying to simplify as much people's trading as I possibly can. So please do subscribe, and I'll catch you guys in the next one.